Bitcoin is a hedge against inflation and deflation. That was Cathie Wood, said a few days ago, while Bitcoin was being liquidated to the tune of $178 million in 24 hours. Most people heard that and thought, crypto person saying crypto things, they scrolled past it. They missed the most important financial warning of 2026. CPI official inflation, 2.4%. Trueflation, real time, 0.97%. The Federal Reserve is looking at that left number and keeping rates elevated. Meanwhile, the real economy is already at 1% inflation and heading towards zero, possibly below. That gap is not a rounding error. That is a policy mistake in slow motion. And when the Fed is forced to correct it, and it will be forced, the assets positioned on the right side of that correction will move fast. Bitcoin at $68,000 right now is not a price in equilibrium. It is the aftermath of an engineered stop hunt, $178 million in retail liquidations in 24 hours, while corporate treasuries were quietly buying the exact same coins that retail was panic selling. MicroStrategy purchased $168 million worth of Bitcoin last week. Same week, the ETF outflows hit the headlines. Same price, completely opposite direction. Cathie Wood is not predicting a crash. She is describing a structural economic shift that is already underway, one that makes Bitcoin not just an inflation hedge, but a deflation hedge. And in the specific macro environment she is describing, that thesis points to a 5x move from current levels. $68,000 today, $340,000, and beyond as this plays out. That is the promise of this video. Now I'm going to show you exactly why it is not hype. It is mechanics. And the best way to understand the mechanics is through three people who are sitting with this exact same information right now, making three completely different decisions. This breakdown is based on a fascinating conversation between Cathie Wood and Anthony Pompliano on his channel. Pomp is a total nice guy, and if you support Cathie's vision, drop a comment below. We love Cathie. And I will know you guys like this content format where we dive deep into the analysis of major market leaders. Hit that like button and subscribe if you want more deep dives into institutional analysis like this. But before I break down the exact mechanism, I need to know where in the world you're watching this from. Drop a comment right now, tell me your city and the exact local time you're seeing this. I want to see how global this community really is. Is it 9:47 a.m., 3:12 p.m.? Comment below. And if you already feel like this is information mainstream finance doesn't want accessible, hit that like button right now. Subscribe and turn on notifications because the next 20 minutes will completely change how you understand the macro game. The best way to understand these mechanics is through three people who are sitting with this exact same information right now, making three completely different decisions. Now, look at this woman at her kitchen table on Sunday morning, laptop open, bank statement on screen, coffee going cold. She is not panicking, she is confused, quietly, almost to herself. I did everything right. Sarah is 34. She saves 30% of her income. 8 months of emergency fund in a high-yield savings account. 0 consumer debt. By every conventional financial metric, she is winning. But Sarah has been feeling for about 18 months like her money isn't going as far as it should. Like something is off. She cannot name it. Nobody around her is talking about it. When Sarah hears that prices are falling, that deflation might be coming, her instinct is, good, my savings go further, I should wait. That instinct is not wrong. It is incomplete. And in a rapidly shifting economic environment, incomplete information is the most expensive kind. Daniel is 29, 2 years in crypto. He has read enough to be dangerous, which means he knows what a liquidation heat map looks like. He knows what fear and greed means. And he knows that when ETF outflows hit the news, retail panic follows. Daniel saw Bitcoin drop from $73,000 to $65,000. Fear and greed hit 8. CNBC ran the headline, institutional investors are leaving Bitcoin. Daniel sold. He told himself he would buy back lower. He is now watching Bitcoin climb back towards 68,000 and refreshing the chart every 4 minutes. Daniel was right about the data. He was wrong about what the data meant. The gap between those two things is where his capital went. Mark is 51. He has lived through the dot-com crash, the 2008 crisis, the COVID collapse, and the 2022 crypto winter. He first allocated to Bitcoin in 2021, 4% of his portfolio. He has not touched it since. When Mark sees what Cathie Wood is describing, good deflation driven by AI, a Fed operating on lagged data, Bitcoin being shaken out of retail hands and absorbed by corporate treasuries, he does not see chaos. He sees the setup he spent 3 years waiting for. Three people, one economic moment. Three completely different responses. not because they have different information, but because they have different frameworks for understanding the same information. Here's the framework, built from the ground up. Starting with the two words at the center of everything Cathie Wood said: good deflation. Most people hear the word deflation and think one thing: prices going down, and they assume that is good. Cheaper groceries, cheaper gas, cheaper everything. That is not wrong, but it is like saying surgery is when someone cuts you with a knife. Technically accurate, completely missing the point. There are two completely different types of deflation, and confusing them is the most dangerous financial mistake you can make right now. Good deflation happens when prices fall because things become genuinely cheaper to produce. Technology improves, productivity accelerates. The same output requires less input. Prices fall not because demand collapsed, but because supply became radically more efficient. Think about flat-screen televisions over 20 years. Personal computers, smartphones every year, more powerful and cheaper. Not because people stopped wanting them, because making them became exponentially more efficient. Good deflation raises the real standard of living. Your paycheck buys more. The economy grows even as prices fall. It is a sign of a healthy, innovative economy firing on all cylinders. Bad deflation is the opposite. Prices fall because demand collapses. People stop spending because they expect prices to fall further. Businesses stop investing because consumers aren't buying. Workers get laid off. Those workers spend less. Demand falls further. Prices fall further. It is a spiral. Japan spent 30 years trying to escape it. The Great Depression was, in large part, a bad deflation event. Bad deflation is not cheaper groceries. It is unemployment, frozen credit, and collapsing asset values across the board. This distinction is the foundation of everything that follows. Here is the critical insight. And this is what almost nobody in mainstream financial media is explaining right now. We are entering a good deflation environment driven by AI. The Federal Reserve is using tools designed to fight bad deflation. That mismatch is the entire setup. That mismatch is why Sarah feels confused. That mismatch is what Daniel missed when he sold. And that mismatch is exactly what Mark has been patiently positioning for. Good deflation does not come from nowhere. It comes from specific, measurable productivity gains. And right now, those gains are happening faster than at any point in recorded economic history. AI training costs, the expense required to build a large language model, are dropping 75% per year. Not over a decade, per year. AI inference costs, what it costs every time you use an AI tool, are dropping between 85 and 98% per year. Think about what that means in practice. A task that cost a business $100 to automate in 2023 costs roughly $25 today. By 2027, it may cost less than $1. This is not a tech story. This is an inflation story. When the cost of intelligence and of analysis, of writing, of coding collapses by 98%, that deflationary pressure flows through every sector. Pepsi cutting the price of Doritos by 15%. Coca-Cola acknowledging consumer pushback against price increases. Existing home price inflation dropping to 0.9% year over year. New home prices already falling annually. Gasoline prices declining. These are not random data points. They are the early symptoms of a broad, structural technology-driven deflation wave. Sarah: so this isn't random. The prices I'm seeing fall aren't just companies being nice. There's a structural force behind this. The two inflation numbers explained. Now you're ready to understand what these two numbers actually mean. CPI, the Consumer Price Index, is the official inflation measure published by the U.S. Bureau of Labor Statistics. It uses a methodology largely designed for the industrial age. It is slow to update. It relies on surveys, lag data, and averaging techniques that smooth out rapid changes. It is not fraudulent. It is just old. It is measuring a fast-moving river with instruments built for a slower one. Truflation is a real-time inflation index built on over 30 million live data points. Actual transactions and pricing APIs updated continuously. As of this week, 0.97% and trending lower. The official number says 2.4%. The real-time data says 0.97%, moving toward zero. The Federal Reserve is looking at 2.4% and saying, not yet time to cut rates. Meanwhile, the economy it is governing is already at near zero inflation, and in several categories, already in outright deflation. This is a big moment. Sarah feels like her money is not going as far as it should. Here is the paradox she has not named yet. In a good deflation environment, cash that sits still is not the safe choice. It is the slow choice. Because while prices in the real economy are falling, the assets that benefit from a productivity boom are beginning to reprice dramatically upward. Sarah is not losing to inflation anymore. She is losing to the productivity gap. The distance between where her capital is parked and where the gains are actually happening. Reaction beat. Sarah: Prices falling doesn't automatically mean my savings are winning. The game changed, and nobody told me the rules changed. To understand the Fed's mistake, you need to understand one structural truth about how central banks operate. They are built to be backward-looking. The Fed does not have a real-time view of the economy. It collects data. That data gets processed and published with a lag of weeks to months. And then the Fed committee meets 8 times a year to make decisions based on what the economy looked like in the recent past. In a slowly changing economy, this lag is manageable. You can afford to be 2 months behind when things are moving slowly. In a technology-driven deflationary transition, where AI costs are dropping 90% per year, a 2-month lag is not a minor inefficiency. It is the difference between steering and reacting. Here is a specific data point that received almost no mainstream coverage, but is one of the most significant economic signals of the past year. The Bureau of Labor Statistics recently revised its employment numbers downward by approximately 860,000 jobs. That is not a rounding error. That is a systematic overcounting of jobs that were reported as existing but did not. What does that revision mean in real terms? If there were fewer workers than reported, but the same level of GDP output, then each worker was producing more than the official data suggested. Productivity was higher than measured. Real GDP growth was stronger than reported, and inflation was lower than reported. The official data had the mix completely wrong. The economy was more productive, less inflationary, and closer to a deflation environment. The Fed has been running policy designed to cool an overheating economy, while the economy it was actually governing had already cooled significantly, driven by a technology productivity surge that the official data simply was not capturing. Powell's term ends in May. The current Fed board, operating on government data built for the industrial age, has been consistently late on this cycle. They were late recognizing inflation in 2021. They risk being late recognizing deflation now. And when a central bank is late to recognize deflation, when it keeps rates elevated while the deflationary wave is already building, it does not prevent the deflation. It amplifies the chaos on the way through. When the correction comes, it will not be gradual. It will be fast. And the assets positioned ahead of that forced pivot will move before most people realize what is happening. Daniel: I sold because I thought macro was bearish for Bitcoin, but if the Fed is about to be forced into cuts, that is the most bullish macro trigger possible? Mark: I have been waiting for exactly this misread. The forced pivot, when it comes, will be large and fast. The yen carry trade. Why Bitcoin fell with tech stocks. There is one more macro layer that has been compressing Bitcoin, and it has nothing to do with Bitcoin fundamentals. It is a Japanese monetary policy story. The Bank of Japan has been raising interest rates after decades near zero. As Japanese rates rise, the yen strengthens. And as the yen strengthens, a mechanism called the yen carry trade begins to unwind. Here is how it works, explained simply. For years, institutional investors could borrow money in Japan at essentially 0% interest. They would convert that borrowed Japanese money to dollars and invest it in higher yielding assets globally: U.S. tech stocks, emerging market bonds, and Bitcoin. The trade was profitable as long as 2 conditions held. Japanese rates stayed near zero, and the yen stayed weak. And when either condition breaks, the trade unwinds. The loans get repaid. That means selling the assets that were bought with the borrowed money. Estimated active yen carry positions still in global markets, approximately $500 billion. That is $500 billion of potential forced selling, not because the assets are broken, but because the financing vehicle is closing. This is why Bitcoin fell alongside tech stocks in recent weeks, not because of a Bitcoin problem, because of how Bitcoin is now embedded in the global financial system through ETF securitization. It moves when the liquidity that funds all risk assets moves. The institutions that wanted to accumulate more Bitcoin at a discount needed retail to panic and sell. The macro environment provided exactly that catalyst. On schedule, on cue. Daniel: So Bitcoin didn't fall because something was wrong with Bitcoin. It fell because of a Japanese interest rate decision. And I sold based on a CNBC headline about ETF outflows. While the macro environment was shaking retail investors out of their positions, something very specific was happening beneath the surface of the Bitcoin market. Let me teach you how to read this. A liquidation heat map shows where leveraged positions, borrowed money bets on price direction, are clustered in the market. If you use leverage to buy Bitcoin, your exchange will automatically sell your entire position if the price drops to your liquidation level. You do not choose to sell. The system sells for you, automatically, at that price, regardless of what is happening in the market. Now imagine you are an institution with enough capital to move the Bitcoin price. You can see this heat map. You know exactly where the largest clusters of forced sell orders are sitting. You know that if you push price down to that zone, millions of automatic liquidations will trigger, creating a cascade of selling that lets you buy large amounts of Bitcoin at a discount. That is not a conspiracy theory. That is market mechanics. It happens in equities, commodities, and foreign exchange every day. It is called a stop hunt, and it is one of the most well-documented patterns in leveraged markets. Look at what happened. Bitcoin swept aggressively through the $65,000 to $66,000 zone, the densest cluster of retail long liquidations according to CoinGlass heatmap data. $178 million in long positions liquidated in 24 hours. Isolated liquidations of $2 million or more appeared precisely on top of the retail stop-loss clusters. And then Bitcoin reversed. It never closed below 64,800 on a daily basis. The wick went exactly to the liquidity pool and reversed. Not approximately, exactly. Classic bear trap architecture. Hunt the weak hands, absorb the forced supply at a discount, load the institutional position, prepare the squeeze. Now let's go beneath the price chart and look at what was actually happening with Bitcoin ownership during this period. Exchange reserves, the amount of Bitcoin sitting on trading platforms available to be sold, are at structurally low levels, and they are not rising despite the price drop. If retail investors were genuinely panicking and dumping Bitcoin en masse, exchange inflows would spike. They have not. Long-term holder UTXOs, coins that have not moved in over 1 year, are unchanged. The investors who have held Bitcoin through multiple cycles, who have the deepest conviction and the longest time horizons, are not selling. And here is the most significant signal. During the exact period when Daniel was selling and CNBC was running headlines about institutional exodus, large Bitcoin wallets, holding between 1,000 and 10,000 coins, accumulated 170,000 Bitcoin in the first weeks of 2026 alone. On a single day in early February, large addresses accumulated 66,940 Bitcoin, the largest single-day accumulation since 2022. Two specific on-chain moves tell the story even more clearly. 909 Bitcoin moved from a 13-year-old wallet, coins that survived the 2011 crash, the 2013 peak, the 2017 run, the 2022 collapse. 2,000 Bitcoin moved from a 7-year-old wallet, both absorbed without any price impact. That is the signature of deep institutional buying, absorbing ancient supply underneath the market, quietly, without headlines. Counterparty risk is the risk that the other party in a financial agreement fails to fulfill their obligation. The bank holding your money fails, the fund managing your investment collapses. The company whose bonds you hold goes bankrupt. In a deflationary environment accompanied by rapid AI-driven disruption, counterparty risk rises sharply. Industries that have been stable for decades face sudden displacement. Business models that worked in a 2 to 3% inflation environment struggle at 0% or below. Private credit markets, where enormous amounts of institutional capital have flowed in search of yield, are particularly exposed. SaaS companies built on recurring revenue face disruption from AI alternatives that cost a fraction as much. Traditional businesses operating on thin margins face deflationary pressure on revenue while fixed costs stay the same. Bitcoin has no counterparty. There is no CEO who can mismanage it, no board that can dilute it, no regulator who can freeze it, no bank run that can drain it. In an environment where the question of who you can trust is becoming harder to answer, zero counterparty risk becomes more valuable. Sarah, I thought holding cash was safe in deflation, but my cash is in a bank, and banks have counterparty risk. The safe choice isn't actually riskless. Mark, I allocated to Bitcoin in 2021 because of inflation risk. I'm increasing it now because of counterparty risk. The reason changed, the conclusion didn't. The 5 signals. When the squeeze begins. Mark does not time the market, but Mark monitors specific conditions that confirm his thesis is intact, and specific triggers that tell him the compression phase is ending and the expansion phase has begun. Here are the 5 signals he is watching right now. Signal 1, price structure. Bitcoin holding above 64,800 on daily closes for 5 or more days confirms the stop hunt. Bitcoin breaking above 70,000 with volume signals the short squeeze initiating. Bitcoin breaking above 75,000 triggers forced covering from the short stack. The squeeze becomes self-reinforcing. Signal 2, ETF flow reversal. 3 consecutive days of net positive inflows to IBIT and FBTC signals that short horizon money is re-entering. A single day of $200 million or more in positive flows is the re-entry confirmation. Signal 3, corporate treasury activity. Any new public company announcing a Bitcoin treasury strategy. Strategy announcing a purchase above $100 million. One announcement restructures the narrative faster than any chart level. Signal 4, on-chain accumulation. Exchange outflows. Accelerating means available sell-side supply is shrinking. A whale address count increasing. Realized price holding above $54,900 means no mass capitulation pressure. Signal 5. The macro pivot. Any Fed language signaling rate cuts or a pause in quantitative tightening equals liquidity returning. USD JPY breaking below 150 signals, the yen carry unwind approaching its peak. Bank of Japan pausing rate hikes provides relief for carry-funded risk assets across the board. Mark. I don't need all 5 to confirm. 2 or 3 aligning is sufficient. I made this decision when I was calm. I execute it now. Daniel. I didn't know any of these signals existed. I was watching price and headlines. I was playing a completely different game. We started this video with Sarah, feeling confused about something she could not name. She has a name for it now. You have just spent 26 minutes building a framework that most people, including most people who consider themselves financially sophisticated, do not have. And let's close by making it concrete and personal, if you are Sarah. The insight that changes everything for Sarah is this. In a good deflation environment, the risk is not that your cash loses value to inflation. The risk is that your cash sits still while productive assets, the ones benefiting from the AI and technology boom, reprice dramatically upward. Cash in a high-yield savings account is not risk-free. It carries the counterparty risk of the bank holding it. It carries the opportunity cost of missing the productivity-driven asset repricing, and it carries the psychological cost of watching a boom happen while you waited for certainty. Sarah does not need to make a dramatic move. She needs to make a deliberate one. The first step is separating money she truly cannot afford to lose, emergency fund, near-term expenses, from money that is sitting still because she has not decided what to do with it. That second category deserves a framework, not a hot tip, a framework. The framework in this video is a starting point, if you are Daniel. Daniel's problem is not a lack of information, it is a mismatch between the time horizon of the information he consumes and the decisions he is trying to make. Fear and greed at 8 is a short-term sentiment indicator. ETF outflows are a short-term flow indicator. Neither tells you what Bitcoin is worth in 18 months. Neither tells you what on-chain data shows about long-term holder behavior. If Daniel wants to trade on short-term signals, he needs a complete short-term signal system. Mixing 2 different time horizons produces the worst of both. The anxiety of a trader with the reaction speed of an investor. The first step for Daniel is deciding which game he is actually playing, then building the right tools for that specific game. Right now, he is playing both simultaneously and losing at both, if you are Mark. Mark already has the framework. The only variable left is execution. The plan Mark made when he was calm, the allocation model he built before the noise, was not built for a comfortable market. It was built precisely for a market that feels uncomfortable to execute in. This market, right now, feels uncomfortable, which means it is exactly the market the plan was built for. DCA still running? Do not change it. Extra capital set aside for structural compression. This is the compression. The signals are aligning. The thesis is intact. Reading headlines about crypto winter. Strategy just bought $168 million this week. Metaplanet is targeting 210,000 Bitcoin. The entities with the longest time horizons are not acting like it is winter. They're acting like it is a sale. For Mark, and for every long horizon allocator watching this, $68,000 is not a problem. It is the setup.